Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the most famous guy that I know in multifamily, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing good. How are you?
Good. How's everything going at SPI? You guys are just knocking the ball out of the park. You bought a deal down in Austin. You're looking at doing some deals down in San Antonio. You guys are busy.
Selling a couple deals too. So yeah, things have been going good. No complaints. It's been continuation of the golden age of multifamily ownership. I just don't think it could be better than it's been, and it keeps getting a little bit better. So every time I say that, we keep seeing more and more rental rate growth here in real time. So the market's absolutely white hot in all respects, both on investment sales and on operations. So no complaints from this guy.
Well, I want to hear from the guy who, I always say Michael Becker's the smartest guy in the room, but it's really our guest today that you've heard him before. He is definitely the smartest guy in the room. He is with a group called RealPage, and RealPage is a technology company that does an unbelievable job of data research. And so we have the head of economic research, chief economist for RealPage, a gentleman named Greg Willett. And so, Greg, thanks for being on and sharing some of your inside information about what's going on in the data of multifamily.
Paul, it is great to be here with you, and thanks for setting the bar so high that I'm going to not be able to meet that description.
So, RealPage, if people are not familiar with that, Greg, can you give us just a high-level overview about what RealPage does, how many employees, and tell us a little bit more about RealPage so everybody has a threshold of understanding about where you come from.
Sure. So RealPage is a technology and analytics company that focuses in on the multifamily sector. About 19 million rental units across the U.S. use some form of RealPage product in running their properties. And certainly we're mining information out of all that technology to track what's going on in the marketplace. And we are a global company. We have 7,000 or so employees. Our headquarters are in Metro Dallas. We've got about 2,500 people locally.
So as you can hear, Greg is very knowledgeable. He's been in the business for a long period of time. He's the guy that we kind of turn to when we want to see what the future lies on the multifamily, whether it is rents or what's going on with construction, what's going on with inventory that's currently out on the ground already. Is it A? Is it B? Is it C? Throughout the nation, Greg and his group over RealPage have just the best technology information about what's going on because they mine this 19 million folks that have some form of data that comes into RealPage. And so I'm going to turn it over to Michael. And Michael, let's kind of talk a little bit about what's going on in multifamily.
Yeah,
white hot industry today.
Yeah, talk a little bit about the state of the market. It's been, as Greg and you and I spoke maybe 6 months ago, and seemed like we were optimistic and kind of pulling out of most of the lockdowns from COVID, and things are starting to perk up. But what's new? Kind of where maybe you can start, guys, setting the stage, kind of where we were finishing off 2020, and kind of what's going on today.
Michael, as you said, the last time we chatted, we were headed toward the beginning of this year, and we were optimistic that the performance would be very solid this year. And I will say, even to the point of we got some client feedback of, you guys are nuts if you think it's really going to come together and be this strong. Having said that, the performance is now exceeding our expectations. Michael, you described the market as being white hot. We did a webcast this week where our theme was it's crazy hot, and here are the top 10 craziest numbers that are out there right now. So, the performances are really exceeding, I think, the expectations of even the most optimistic people.
So we I remember when we talked, I kind of had the tale of two markets kind of theme where we had the on markets and the off markets. That was kind of what we were seeing, most of the latter part of 2020. Is that really playing out today? Do we still kind of have the on markets and the off markets?
It's true to some degree, but the off markets, you're down to a handful of places, and it's really those gateway markets, your New Yorks and San Franciscos, and even those spots are making some progress month over month. The whole relative to where we were pre-pandemic is still pretty deep in those places, but pretty much for the rest of the country, you've now got performances that not only look good compared to where we were at the bottom when we were struggling, you're just well ahead of the conditions that we're seeing pre-pandemic in most places.
So where were your general expectations for occupancy, rental rate growth, et cetera, as we kind of entered into the year? And then what are I know the answer to this question because I live it every day, but where are we today compared to where the expectations were?
Yeah, I mean, so for occupancy, we started the year, we were high 95% range, just a little bit under 96%, which is healthy. And I'll point out a lot better than we've done in previous recessions. And even with a lot of new product delivering this year, we expected that occupancy would hold steady. So we've had some uptick in the occupancy rate so far this year because demand has been so strong. So we're a little bit above the 96% mark now. I mean, it wouldn't surprise me if by the time we finish prime leasing season this year, that you're right in line with all-time highs for the U.S. on occupancy. So that has really mostly followed our expectations. Where the outperformance has been on pricing power. And so, I mean, we thought that we would get a little bit of rent growth this year for the nation as a whole. The annual change number as of May was a little bit north of 4%. So, I mean, and you've got a lot of places where you're actually have double-digit rent growth at this point. So again, that's where the premium has really showed up.
And so is that, so you talk about your gateways, New York, San Francisco, LA, kind of your drags, your negative or flat to negative in those markets. And then you got some of these markets that are outperforming. Is it generally the Sun Belt is winning and the Midwest and gateway markets are struggling and you average all that together, we're north of 4?
Certainly the winners are the Sun Belt, and I'll point out the one that's really a stunner is Phoenix, where you've got annual rent growth of, I think the number was right at 15% as of May. So solid performances in most of the other Sun Belt markets, Atlanta, some of the Florida markets, good numbers in Texas, and actually well above historical standards, but not quite up there with Phoenix and Atlanta. And then solid performances in the Midwest too. So, I mean, again, the strugglers it is really just those gateway markets, and particularly New York and the Bay Area. Still some work to do in places like LA and Boston and Washington, D.C. and Seattle, but the hole's not as big as it is in New York and San Francisco.
All right. And so with the rental rate growth, is that kind of evenly distributed across all the property grades A to C, or is there some disparity between the different classes?
Well, as we came into this year, I mean, we were already doing pretty well in the Class B and C product. The real struggle was on the Class A properties, and then that's been the real surprise for us this year. I mean, that's where there's been some really big momentum, and even though we've been delivering a lot of product, lease-up rates at these properties that are just being delivered have gone, after being sluggish last year, have gone, in the worst cases, are back to normal, and actually in a lot of cases are above normal now. So that means the rent giveaways are not as steep as we had anticipated in the new product going through lease up. And then existing stabilized Class A properties, for the most part, the operators have said, hey, we're not even going to try and match the giveaways that are occurring at the lease-up properties. We're just going to drop our concessions, and they're still doing well. So the surprise number is that Class A rent growth from my perspective.
Got it. And is there some differences? Or why is that, you think? Is that because of the home affordability being challenging with the single family prices going up? Are we seeing some pullback in new inventory being delivered? What's behind that?
Well, we're certainly not seeing pullback in inventory that's coming online. And obviously, developers are struggling to get projects over the finish line given shortages in materials and to some degree labor, but they are getting it done in huge numbers. So again, it's the demand story that's really what's helping this top tier product. And again, the leasing activity is strong. And what I'll point out is we've had recovery in the economy. What we've really seen are some good numbers and good household formation for high income households, and more so than in the lower income households. And so the typical income of people who are renting units right now, as of May, so these are U.S. numbers, the typical household income for someone who rented an apartment in May was $68,000 for the country as a whole. If you rented a Class A apartment, the typical income was, I think the number was $93,000. It was in the 90s. So again, strong demand from affluent households.
Yeah, that was probably the question I was asking. Who is renting these days, and then in starts. Tell us a little bit about starts of, because labor is difficult to find these days, and lumber prices have been such challenging. They're doubled. I think we saw the peak in May. We started to see lumber go down. What's your take with apartment starts that in 2-3 years from now that they'll be ready to go?
Yeah, Paul. I mean, it's a question that we get a lot. As we came into this year, our forecast was that starts are going to be down a little bit, but not a lot. I mean, there were certainly people out there who were expecting a big cutback, but we didn't really see that as likely to happen. And if you look at permit numbers right now, they're following what we thought the numbers would be. I mean, it's off a little bit relative to where we had been, but not by much. And for every market where you see there's some pullback, there's another market where, in fact, we're accelerating. So I think the numbers of deliveries over the next couple of years is not going to change that much from where we are now, but we will sort of reorder the markets to some degree in terms of where products being delivered.
What's different there? Is it obviously more suburban than urban has kind of been the craze? Or are there any markets that are going to see more and see less?
Certainly it is a little bit more suburban than what we had been doing. And we'll circle back again to those gateway markets. It is tough to get starts capital to jump in for some of these really expensive markets, and particularly, the towers in New York and San Francisco. That's off. At the same time, some of these Sunbelt markets that we had talked about are really doing a lot. But interesting, you've actually got to pull back in some of the Sunbelt markets as well. I mean, we're all here in Dallas. The start numbers are actually coming down in Dallas. Dallas is still number one, but it's possible by the time we get to the end of this year that somebody's going to knock DFW out of that top spot. And particularly, I'd keep an eye on Phoenix, which it's really surging there. And then another interesting one is pullback on construction in Atlanta, even though that one's the performance is off the charts. But we talked about, you want to be building in the suburbs, and these suburbs in Atlanta will not approve new construction. And so people would love to be building in Atlanta, but you can't get the deals done right now.
Hey, Mike, Greg, let's jump in the car and drive around the state of Texas a little bit. we jump in the car and we drive on down to Austin. What kind of a market are you seeing, Greg, in Austin these days with rents and all kinds of things going on? Mike, you have a couple of properties. Maybe you could just talk a little bit about the hypothetical. How are rents on your properties these days?
I mean, rents are moving pretty hard, and occupancies at all-time highs. And a lot of these, we just bought a brand new deal from the developer that was we awarded the deal around the time of Snowvid with the ice storm, and closed it a few weeks ago. And by the time we bought it was around 88%. By the time we closed, it was like 97%. And I had a bunch of concessions. All the concessions went off. So basically just stabilized. As soon as the ice melted, the market heated up and the thing stabilized in short order. That's kind of what we're seeing down there.
And I'll jump in and I'll circle back to that conversation we had late last year, beginning of this year. Austin, was the one that was surprising us in that it wasn't doing as well as the numbers in the economy would suggest that it should. But boy, did that change as we got into this year. And again, in our numbers, occupancy in Austin, 95, 96%. We've got 6% annual rent growth. I want to say in Class A space, the rent growth in Austin is like 8, 9%. So really active. Lots of construction activity in Austin. I certainly want to bring that point out, and that just in terms of the total volume that's under construction is 21,000 units, which is 8% inventory growth over the next year and a half or so. The only place that comes close to, well, the only two places that come close to that 8% inventory growth or so are Charlotte and Nashville. So lots of building.
Inventory growth. I mean, that's huge. I mean, who's moving to Austin? Is it for all the high technology jobs in Austin?
Certainly, it is high end focused, and I mean not all technology, but Austin, as we look at national recovery of markets and their employment bases, we've got one major metro that's made it all the way back to pre-pandemic numbers right now. That's Salt Lake City. Austin is next on the list. We will get a new set of employment data next week, and I think that's going to show Austin is completely recovered from any downturn, and you're setting new highs on employment.
Let's jump back in the car, drive a little bit farther south to San Antonio. Mike, you're buying a couple of properties down there. Why do you like San Antonio? And let's talk with Greg a little bit about why he likes San Antonio.
Greg mentioned there's my impression of the two markets, San Antonio and Austin, very similar in proximity, or close to proximity, being hour and a half, 80, 85, 88 miles or so away from each other. Very similar in size. I think San Antonio is about 2.55 million. Austin is about 2.35 million. San Antonio has a little bit less multifamily units, but relatively similar size in the base. And they've been kind of delivering similar numbers of units for the better part of, say, 2014 through 2020. Well, Austin was able to absorb those, and San Antonio hadn't. So San Antonio got a little sluggish, concessions, higher vacancy, slower rent growth. It doesn't have the same dynamic drivers from high-end job growth and the wage growth that Austin does, but it's slow, steady, military, manufacturing. That's kind of your economic base there. Tourism. So tourism is starting to come back. So I think a lot of those jobs are coming back, Paul. And looking at the supply, I think as Greg said, there's about 20,000 units going on in Austin right now under construction. There's like 4,500 units or 5,000 units, something like that in San Antonio. So it's about a quarter or so of the supply. And what we were seeing specifically in the Class A, maybe not as much in the workforce housing, is that occupancies firmed up. So stuff that has struggled have now all kind of leased up. Seeing the concessions basically are a thing of the past where they were more prevalent, and you're actually starting to see some pretty decent rental rate growth, in particular compared to historical standards from San Antonio. So my view, it's a pretty good time to enter the market, and that's kind of what we're betting our money on. I don't know if Greg has any comments and can confirm or deny my rumors here.
Yeah, I by and large agree with that. And as you pointed out, the construction numbers in San Antonio had slowed down a little bit. And so the current deliveries are low by historical standards. It's starting to move up a little bit, but again, you're moving up from, hey, a third of as much as in Austin to maybe half as much as in Austin. So in the big picture, it's certainly not off the charts on building activity. I will say that our numbers for May had annual rent growth in San Antonio at around 5%, and even stronger than that in Class A. That's really unusual for San Antonio, and we think this one will do well. That rent growth number is not going to stay at where it is right now, however. I mean, it's going to come back to more like the 3 to 4% range.
So the San Antonio market, your numbers are the rent growth is largely weighted in the Class A, not as much in the workforce housing. Is that accurate?
Certainly the big number right now is Class A, which had been struggling. The workforce is more normal, is more 3 to 4% growth.
Yep.
All right, jump back in the car. Let's go over to Houston. Everybody from Dallas always wants to buy stuff in Houston. Everybody from New York wants to buy stuff in Houston because maybe it's a cheaper price of properties down in Houston. Greg, what's your take about Houston?
Is your glass half empty or half full is what I would ask you on this one. I mean, certainly the numbers look good relative to where we've been in Houston over the past few years. In our stats, occupancy is about 93% right now. Annual rent growth is 2.5%, which, hey, that's not what the other Texas markets are doing. It's below the U.S. number. But at the same time, we went through several years where the Houston rent change number was 0 to slightly negative. So certainly better than this market has been doing, not up to what we see in some other spots. I always view Houston is a hit and miss market. You get the right property in the right neighborhood and you will do well, but the market overall is probably not going to do as well as the rest of Texas. And the hot places right now are the middle tier to upper end suburbs. So places like Katy and Sugar Land and Conroe are doing really well. I don't know that to be honest, I don't know that I'd be buying urban core in Houston at this point.
All right. We jump back in the car and we're going to go to our favorite town, Big D. Michael, what's your 2 cents on Big D? And Greg, what's your 2 cents? So Michael, what's going on?
Yeah, I mean, it seems like everything's all-time occupancy highs, and my portfolio see tremendous rental rate growth. I think specifically, we got mostly out of the workforce housing, Paul. We have 1 or 2 deals left to come on the workforce housing, but we have a lot of A- to A, so 20 years or younger. And it seems to me the best performing deals right now would be, I'd call it your A- product away from supply pockets. So if you could buy in the mid cities, like Hearst, we have a deal in Hearst that's killing it. We have a deal in Mesquite that's killing it. A deal in West Fort Worth that's killing it. And it's kind of that 10 to 20 year old product that has no supply near it. And those deals are seeing, for May, like 20% trade outs, like ridiculous numbers. And, year over year, we're seeing, probably 8% growth if you annualize it year over year. So that's kind of what I'm seeing. Very, very bullish. It seems like the core product is, from a pricing standpoint, the core and suburban are trading pretty damn close to each other from a price per door basis. So we've been a little bit more core focused here last year and a half. And, but the suburban deals are absolutely killing it. A lot of concessions on some of the newer stuff is kind of pulled off. But that's kind of my take. Very bullish. I foresee that drop in permits that Greg just mentioned as something that will probably continue to put upward pressure on rents in 2023, 2024, as the units that should have been delivered don't get delivered. That's kind of my crystal ball. I don't know if Greg agrees or disagrees with that.
Yeah, I mean, it's certainly a good performance in DFW right now. We've got occupancy 95% or so and trending upward at this point, and rent growth around 5% overall. So again, good numbers. suburbs outperforming urban core a little bit, but the urban core numbers are not bad. So some solid progress there. Again, we're going to have somewhat fewer deliveries over the next couple of years, but it's not a huge cutback. We are mixing it up by the neighborhoods and some of the places where we had been delivering the biggest blocks of completions. They might still be the most active submarkets, but the numbers themselves are not quite as big. And then some places where we hadn't been building at all, we are now starting to get some new construction activity. And I did a session for the Urban Land Institute last week where I was looking at some of these neighborhood numbers in DFW, and the leaderboard, I'll point out, like Richardson was not on that list, which has been a super hot construction market. West Dallas, North Oak Cliff was not on the leaderboard. Downtown Fort Worth was not on the leaderboard, but we had places like Burleson and East Plano. So places where we haven't been building are starting to show up. So we're
Are you seeing differences in the 5% overall rent growth that you said? Is that kind of similar to what we talked about with San Antonio? Is that more heavily weighted on the Class A for the rental rate growth and less on the workforce? Or is it more evenly distributed across property grades?
Yeah, I mean, the biggest numbers right now are, again, Class A. It's recovery of what had been lagging behind. So certainly good growth numbers on the workforce, housing as well. But again, it's Class A driving the market in these Texas metros right now, with the exception of Houston. I don't know if we hit on that. It's really the Class B middle market product that is driving the rent growth in Houston.
Let's walk around just briefly in some of these secondary and tertiary markets of, say, Lubbock or Amarillo or West Texas, of Midland, Odessa, even come back to East Texas. Same rental growth in some of those other markets instead of the big gateway markets of the four large metros in Texas? What's your 2 cents?
Some good numbers in some of these small markets. Hey, not Midland, Odessa. The oil patch is still continuing to struggle. And even though oil prices have gone up, the number of active rigs has not gone up. So that means we don't really have the employment growth in West Texas that typically would come with firming prices. So that's struggling. But the other small markets looking pretty good at this point. Always a little bit more volatile in those markets than it is in the big ones, just by definition. If you're a small market and, hey, you get one or two properties under construction, that changes the situation a little bit. And you can have a big move by just one single employer that suddenly changes things in the small markets. So inherently a little bit more risk, but they're doing okay.
Anything on the horizon? Do you think that we could see storm clouds? I mean, I think one of the things that I see on the lending side is the last 6 months to the last 8 months is all these bridge loans that are being done based on future rents where they're hopefully going to go. And so some people are using this 5, 6, 7 in interpreting that's going to be for next year, maybe the year before, the year after. And that's where they should be buying the property today. And, Fannie Mae and Freddie Mac are only going to look through the rearview mirror and how the properties performed in the past. But a lot of these non-recourse bridge lenders are giving solutions to folks with higher leverage based on future rental growth. Are you seeing in the prices of these properties any concerns of what the future lies with valuation on some of these properties?
I do think you have to be careful to, again, we're calling the market crazy hot right now. Even though we're optimistic, I don't think the rent growth numbers are going to look as good at the end of the year as they do right now, and certainly not at this level. sustained over time. And I'll point out right now, I mean, if you're looking at annual rent change, right now you're comparing to a year ago, which was when we were struggling. So, just the way math works says that those numbers are going to come down a little bit. Also, there's still unknowns in terms of what's going to happen with people going back to the office and versus work for home. What happens when kids go back to school full time? How do we deal with childcare issues? And so I will think we're going to see a switch as we get to the last half of this year and then on into next year, that instead of producing a whole bunch of high paying jobs, we're going to produce a bunch of lower paying jobs. And that produces fewer new households than creating high-end jobs. So there's that question. And then the other one that I think about a lot is, obviously we're seeing some inflation right now. The consensus view is, that's temporary as we deal with some product shortages and people just being really to go out and eager to spend money at this point. So that's driving up costs, but at this driving up spending. But at the same time, if that seeps over into big wage growth, then that inflation sticks and kind of changes the picture here. And I don't know. I'll stick with the consensus and say it's temporary for now, but every day I'm starting to feel like maybe it's less temporary, and inflation is something that we're actually going to have to deal with in the future.
So what happens if we start seeing these wages stick? We see rental rates continue to have upward pressure?
Well, to get your margins that you're looking for, yes, but at the same time, the way the housing world works, it comes down to that supply-demand equation. And if your costs went up, your renters don't care. I mean, that does not necessarily translate into the rent growth pace accelerating as quickly, although you have a better chance of that happening at the high end, because again, we said incomes are looking good for that high end product right now, but could be more challenging as you get into the workforce category to actually have rent growth that's going to keep pace with inflation. Again, if the worst case scenario comes to pass and inflation is systemic and sustained.
I feel
we don't end on that note, Paul. So
yeah, let's end on that
bring
note.
us back to the sunny world.
The sunny world is that you can't get better information than you can get from Greg Willett over at RealPage. I mean, some unbelievable updated information almost on a daily basis that comes out of his group and all of his team that just go through and research the data, and they advise groups that are building apartments. They're advising groups that are owning apartments. They're advising the lenders. I mean, there's so much great information. And so what's the best way for people to kind of get into the loop of trying to get information from your group at RealPage, Greg?
Certainly, if you just want to track what's happening in the marketplace and how it's moving on a day-to-day basis, we do have a blog out there, realpage.com/analytics. We post new information every single day on what's happening in the marketplace. And obviously, the RealPage general website can talk you through the many, many, many different technology products that we have that can help you in running your business and making investment decisions.
I feel so much smarter after talking to Greg, Michael. I mean, any final comments at all?
Yeah, two questions, I guess, Greg. So one, if you had to put your grandma's money in a deal, what part of town or what part of the country would you think makes the most sense for the next 2 to 3 years, and what property grade? Where are you kind of the most bullish on right now?
I'm a big fan of the investment thesis that just get in front of demand. And so to me, that is Sunbelt, obviously. And if I'm picking suburban class B, A minus to B product, I will point out that's been our story for a long time. Institutional capital didn't agree with us for a bunch of the last cycle, but what I've said now is what everybody wants to do at this point in the marketplace. So, boy, would there be competition for those deals, and you're going to have to settle for maybe less than ideal return. But I do think that the overall performance in those product niches will be pretty impressive.
Got it. And then you said that I watched your webcast, so you guys had 10 crazy numbers that kind of surprised you. Maybe one or two of those things that would be a surprising stat for listeners of the podcast.
Hey, number one was the rent growth numbers, and number two was the income number. So we've hit some of those. I'll get in the weeds on operations. This is the one that's kind of fascinating to me that I'm exploring a little bit further. It's the number of vacant days between leases. So how long does the unit sit vacant as you're doing the turn and getting it back out into the marketplace? The May number was down to, I think for the nation as a whole, it was 21 days, which was cutting off 3 to 5 days from where it had been. So if you think about, for every single lease, you're going to cut that loss of revenue by 3 to 5 days. That's a big deal in the bottom line.
Yeah, that's nice. So that just kind of shows the strength of the market. But Paul, I don't have any more questions. I appreciate you coming on, Greg.
Some great information coming from Greg Willett at RealPage. Again, if looking to get information, go to the realpage.com website and become an active learner about what's going on with RealPage. Michael Becker, always a pleasure. Thanks for spending some time with us in the podcast. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.